Hello, welcome to our conversation on financial reporting. Today we'll spend some time on understanding buyback of shares and also see and examine some of the buyback uh, experiments in Indian corporate sector. So buyback of share refers to a company purchasing its own shares from the existing shareholders, resulting in the reduction of the share capital. So buyback is one of the ways of capital reduction. Indian companies are not allowed to hold shares, its own shares, as investment. So if they buy by using the existing cash on their balance sheet, then they need to go for the capital reduction. And buyback of share is a highly regulated process. It is governed by the Section 68 of the Companies Act and also regulated by Security Exchange Board of India, SEBI's buyback of securities regulation for listed companies. And any company going for the buyback is required to follow certain conditions to undertake buyback. It must be authorized by the Articles of Association. Shareholders' approval by special resolution is needed if the buyback exceeds 10% of paid up capital and free reserves. But board's resolution is sufficient if the buyback is less than or equal to 10%. The conditions also talk about the maximum amount of buyback and maximum number of shares to be bought back. A company can buy back shares up to 25% of the paid up capital and free reserves. And the word free reserve is called free because it is available for distribution of dividend. Normally, the retained earnings is considered to be one of the important components of free reserves. The maximum number of buyback shares, the number of equity shares bought back should not exceed 25% of the paid up equity shares. So there is a cap on the amount as well as the cap on the number. There is no cap on the price, but price depends on the amount and the number. The other important condition is a cap on the leverage, normally measured through debt equity ratio. Debt equity ratio post buyback not to exceed 2:1. Debt equity ratio post buyback not to exceed with 2:1. What is this debt equity ratio? Debt equity ratio is debt by equity, and the debt is total interest bearing liabilities. So both short term and long term borrowings. Equity is a capital plus free reserve. So the debt equity ratio should not exceed 2:1 post buyback. And all the shares bought back need to be cancelled, extinguished, removed from the market within 7 days of the process of buyback being completed. And there is also a condition on the fresh issue of shares. No fresh issue of the same kind of shares be made within 6 months of the buyback. However, exceptions are there for bonus issue or employee stock options. Moreover, there is a time frame condition also. The buyback must be completed within 1 year from the date of passing the resolution. Mode of buyback. The buyback can be done through tender offer, That means from the existing shareholders on a proportional basis, and the price is determined by the company. Or the buyback can also happen through the open market, where through the stock exchanges. The company purchases those shares from the market directly. Whereas in case of tender offer is made to the shareholders and shareholders are required to tender their shares. The sources of this buyback, because capital reduction happens, so the Companies Act and the regulations very clearly says what will be the sources of this buyback. Free reserves. These are the accumulated profits of the company. They're called free because they are not earmarked for any specific purpose and they're available for distribution of dividend. Some cases, as given by the Companies Act, securities premium can also be included, but most of the time is not included. The revaluation reserves are not included. OCI are not included into these free reserves. Often, company can also go for the proceeds of any shares or other specified securities for buyback, but not of the similar type, same type of the security. So whenever there is a buyback, the financial statements are affected through three important items: capital, other equity, and cash. Capital reduces to the extent of the face value of the shares bought back. Cash reduces to the extent of the buyback price into number of shares bought back. And other equity reduces to the extent of the buyback premium. And the buyback premium is the excess of the buyback price over the face value. One of the reasons for the companies to go for buyback is to improve the earning per share. Buyback typically increases the earning per share because earning per share is a PAT or net profit divided by number of shares. So all other things remaining same, post buyback, the number of shares reduces. If the net profit remains same at the time of buyback, the earning per share will rise. Let us see some buyback decisions of some of the well-known Indian companies. One of them is a Bajaj Auto Limited. In 2024, Bajaj Auto Limited went for a reasonably big size of buyback of shares. The price of buyback was rupees 10,000. The buyback of price represented 77 to 74% weighted average price is this amount of premium to the market price, 77 to 74% premium on the price of the BSE or NSE, average price. The buyback price is also about 900% over the book value of the equity, book value per share. The book value was 913 per share as on 31st March 2023, 913. And the price for buyback was 10,000. So buyback price is around 9.9 times of the book value per share. The amount of buyback is was 4,000 crore. And this 4,000 crore, as we have seen the condition, should not exceed, the buyback amount should not exceed 25% of the capital and free reserve. So in case of Bajaj Auto, the paid up capital and the reserve, free reserves was around 24,000 crores. So as per the Companies Act, the cap 25% of the capital and free reserve, both standalone and the consolidated, was in the range of 6,100 to 6,900 crore. That means the company could have actually bought back shares up to 6,200 or 6,900 crore. But the buyback amount announced was 4,000 crore. So it was well below the cap, the condition of that cap on the buyback amount. And this 4,000 crore was only 16% of the capital plus free reserve. The Companies Act allows up to 25%. So this 4,000 crore is around 16% of the capital plus free reserve. So we can see that buyback of Bajaj Auto, the price was 10,000, the buyback amount was 4,000 crore, the number of shares are 4 million, 40 lakh shares, which is about 1.4% of the number of shares, and the amount is 16.3%. So two important conditions, the cap of the amount 25% and cap of the number 25%, both the conditions were fulfilled. Because of the buyback, the amount of paid up capital and the number of shares is expected to fall. So before buyback, we can see that the number of shares, equity shares, is 2,831 million rupees, the capital. 2,831 million rupees or 2,831 million equity shares number. Post buyback, that will become 2,791 million rupees. So the fall in the capital is because of the buyback of shares, and the capital is always shown as the face value. Any excess paid will affect the free reserves. And interestingly, assuming that all the buyback shares are actually bought by the company, the post buyback, as per the information given in the offer document itself, shows the 4% promoter stake goes up to 55%. So it's a marginal increase so promoters stand to gain. And those investors, the promoters, other investors, have reduced to the post buyback. And Bajaj Auto has been doing this buyback of shares as a means of distributing the cash. In 2022 also, they made 2,500 crore buyback. In 24, it was 4,000 crore buyback. In 22, the buyback price was 4,600. In 2024, the buyback price was 10,000. In 2022, it was an open market approach. In 2024, it was a tender offer. The 2022 buyback completed in October 22 and 2024 buyback completed in March 24. So it's a periodic buyback happening in Bajaj Auto. This is not the only Bajaj company which uses the buyback as a process of rewarding the shareholders. Bajaj Consumer Care also has been using the buyback as a strategy. And Bajaj Consumer Care Limited in 2025 has announced buyback of shares. We all know that Bajaj Consumer Care is a leading personal care company in India and primarily known for its hair and skincare products. And they have a strong brand portfolio, includes Bajaj Almond Drop Air, which continues to be doing extremely well on the market. The buyback announced by the company, the amount is 186 crores. The number of shares expected to be bought back is 64.34 lakh shares. And the buyback price is 290. The approach is also tender offer. And this offer is coming to 4.69% of the equity as of 31st March 2025. So below the threshold or the condition given by the Companies Act and SEBI's regulation. The record date is September 2025. The buyback price announced there, which is 290, is about 26% or 25 to 26% premium over the market price, the weighted average market price, as on April 29, 24. As expected, here also the promoters decided not to participate. So the all other things remaining same, the promoters and promoter group, the percentage of holding increases from 39% pre-buyback to 40.9% post-buyback. And this is 25. In 24 also, buyback was the Bajaj Consumer Care Limited used buyback as a route to reward the shareholders. And you can see the price was same, 290 per share. And the amount of buyback was 166 crore. The present buyback is 186 crore. The number of shares is 57 lakh equity shares, which is amounting to about 4.2%. And that happened in 2024, July. One of the companies in India which has been using buyback as a regular approach or a ways or the process of giving money back to the owners is a TCS. We can see that in 2016, 17, 18, 19, 19, 20, 21, 22, even 23, 24. Regularly, the TCS has been using the buyback route. And the buyback price, the face value is 1, and the buyback price is at a high premium to the market price. And on average, 1 to 2% of the capital is bought back. But the face value is 1, and the price buyback premium is very high. It has been observed that buyback, which leads to reduction in the number of shares, reduction of capital, many companies, particularly the multinational companies, use buyback as a process of delisting their shares from the stock exchange. And some of the popular companies which have used this route to become closely held and then delist are Philips India Limited, Cadbury's Limited, Otis Elevators Limited, Carrier Air Conditioning India. These are some of the companies which have used the buyback to delist. So reducing public shareholding below 10% via buyback offers to qualify a voluntary delisting. Often, MNCs prefer this route to regain full control and reduce regulatory control. So mostly the main purpose of delisting is to increase the parent's stake on the company and reduce the regulatory cost. Once a company is listed, the information to the stock exchange, SEBI's regulation, all need to be fulfilled. So the regulatory cost will be high. So by delisting, companies reduce this cost. So to summarize, buyback is a process of capital reduction. However, it affects various aspects of the financial statement. Capital reduces to the extent of the face value of the shares bought back. The number of shares reduces. The buyback also reduces the cash to the extent of the buyback price into number of shares bought back. It will have an effect on the book value per share, because the book value per share is the equity divided by number of shares, and number of shares reduced after the buyback. All other things remaining constant, the earning per share, which is PAT by number of share, is expected to rise. Now, because of the effect on the earning per share and book value, price is also expected to change. So buyback is a very important and a strategic tool in the hands of the management to manage the shareholders' expectation and in the process, the share price. Thank you very much.